Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. So the time has come round again to have another chat with Andrew McHattie, the editor of Investment Trust newsletter, about some of the more interesting announcements that have come out in the last week or so. We're going to be moving mostly down towards the smaller end of the market capitalization range. There hasn't been a lot of news further up the scale, but lots of interest, as always, things to talk about. So I think essentially perhaps we might start, Andrew, by talking about consolidation. And perhaps we could kick off by talking about what appears to be happening at Henderson European. This is a trust where recently these two co-portfolio managers departed to go and move somewhere else. So where has that left us? What has the trust been saying? What has the board been saying about this situation, Andrew?
Yeah, thanks, Jonathan. Well, there are so many of these consolidation stories and ongoing corporate actions that they're quite hard to keep track of. And this one is in its next phase, really, because Henderson European Trust itself is the outcome of a merger last year of two Henderson European trusts. And in early February, the two co-managers resigned, which has ushered in a new phase here. So immediately, Janus Henderson replaced those managers with two other managers from their team who are both experienced European equity managers. They're Robert Schramm-Fuchs and Nick Sheridan. So they've taken over. But I think because this resignation was unexpected, it triggered another strategic review. And the trust has now said that this is at an advanced stage and that it's received a number of proposals, including one from the existing managers, Janus Henderson. So we'll have to see what the outcome is. Apparently, a substantive update is coming with the half-year results by the end of June. So we'll have to wait and see what the trust is going to say. I don't know what the outcome's going to be. The trust looks okay. It's on a 7% discount, which is not unreasonable. But if you look at the big trust in the sector, Fidelity European, that has much greater scale. It's about 3 times the size, and it's on a 2% discount. So potentially Fidelity could make a pitch for this, or one of the other managers in the sector. So I suppose it depends on just how convincing the new managers were when they made their proposal to the board.
Yes, I think that's fair. I'm looking at the share price performance, obviously been net quite good so far this year, but it has, of course, disguised, like a lot of trusts, significant volatility. It's been up and then down very sharply and now back up again, but it's actually close to an all-time high. But the discount, intriguingly, has come in as well. I think it's, as you say, into around 7%, which is the best it's been for, 3 or 4 years, I think. The trust, though, it's a decent size, isn't it? The Fidelity Trust obviously is much bigger, but it's still around 600 million, I think, market cap following that merger. But it's fair to say, I think it's a blow to Janus Henderson that those two co-portfolio managers left, and they left voluntarily. It wasn't like they were asked to leave. So I don't know what that suggests. It's not exactly a vote of confidence in the future of that trust. Do you think this is a case where the incumbent, obviously has an advantage in starting as the incumbent and haven't had a chance yet to prove themselves with the new management team? But normally when boards announce a strategic review, it's quite rare that the trust's mandate ends up with the current manager. I think that's a fair comment, is it not?
Yes, I think maybe this is just human nature, that when there's a beauty parade, the eye is drawn elsewhere. But I think in this case, actually, Janus Henderson probably have a decent case to retain it. I don't think it's an obvious switch anyway, because actually most of the European trusts have had a pretty decent year as people have been switching some assets from the US to Europe. And this trust has participated in that. And these are not new managers. These are not a pair of interns that have been hired. They're very experienced European fund managers with a good track record. So I would think Janus Henderson have a good case, but I'm not privy to the discussions, and maybe someone's got a better case. And to some degree, I think there's a bit of a requirement now for boards to initiate these wider ranging reviews when there's a shift, when perhaps 3 or 4 years ago, actually an internal change of management wouldn't have triggered anything like this. But now you've got to be seen to be doing this, to be making sure you're saying to the market, look, we've looked at all of the management possibilities and we've done our job properly. And this is what we're going to go with going forward. So maybe there's just more of a requirement now for a public discussion. It doesn't mean, I think, that there's going to be any change.
Right. I think that's fair. I guess I wonder why the board came out and said this. I guess it's because they had their AGM, did they not? And they had to update the market on what they were thinking. It is interesting, the European sector. I mean, just looking at the performance over the last 5 years, there's been a huge dispersion, isn't there, between the best and the worst performers. J.P.Morgan European is at the top, has done particularly well over 5 years anyway, followed by Fidelity European and Henderson European about the same. And then three others, including European Opportunities Trust, which is obviously struggling and is being threatened with eventual wind down, I guess, if it doesn't improve its performance pretty quickly. And then the Bailey Gifford Trust as well has not done particularly well. So Europe has been a very good place to be this year, but it's actually not prevented there being this considerable dispersion, as I say, in performance. But the Henderson performance is not bad. One can't say that it's been terrible. So maybe you're right. We'll find out quite soon anyway. They're talking about making, as you say, a statement in June, I think, where they're going to announce the outcome of all this. Another interesting situation that's just come to the fore in the context of consolidation concerns Warehouse REIT, which has been the subject of a bid. Perhaps you can fill us in on the latest development on this one.
Quite an unusual one, this one, Jonathan, because again, when a bid is made and agreed, we tend to think that's it, end of story, it's all over. But in this case, it isn't. So at the end of March, Warehouse REIT received a final cash offer from Blackstone Europe, which was the end of a long courtship, actually. Blackstone Europe had made a few approaches, and this one was agreed, and the headline figure was 115 pence per share, although actually if you took off the 1.6 pence dividend to be paid, it was 113.4 pence net. But that wasn't the end of the story, because when Blackstone conducted its due diligence, something we often hear about, it threw up some doubts over the valuation of the Trust's big development asset at Radway Green, and that meant actually that Blackstone said they couldn't support their prior bid. So we have a new deadline now of 30th of May, and we're going to get a bit more news on this. The shares in Warehouse REIT have fallen back quite a bit because they're worried now that this bid may not complete, it may not go through. And it's quite intriguing. My thought is that actually Blackstone spent a long time courting Warehouse REIT, and I don't think they're going to pull out completely. And that we have some established parameters here, because the Warehouse REIT board previously rejected a bid at 110.5 pence. So my feeling is that everyone can save face here if there's an agreed bid now that's between 110.5 and 113.4. So we'll have to see if that's what occurs. But my feeling is there's a bit of speculative value now in these shares at about 98 pence, because they're now quite substantially below that potential bid price. It's interesting to see, actually. I don't know if this is just opportunistic by Blackstone and they're thinking we can get this a little bit cheaper than we thought, or whether there is something significantly awry with the valuation on Radway Green. Either way, I think it's a good example, actually, of how bids are not necessarily completed exactly when we think they are.
Indeed, and it will be certainly, as you say, unusual to see something trading at quite a wide discount to the bid. Yeah, very interesting indeed. Okay, so moving on. We've had an announcement this morning from J.P.Morgan India. We're recording this on the 19th of May, where the board has introduced a raft of new measures, I think partly in response to the fact that the performance of this trust has not been as good as some others. Can you tell us quickly what the details of that were, Andrew?
Yeah, so here's an example actually of where a strategic review didn't lead to a change in management where perhaps we thought it might, because this was really initiated for a different reason, because here the performance has been very poor, actually for quite an extended period. And so that put pressure on the board to potentially make some changes. So they've now announced the outcome of their strategic review, and they've said that they're sticking with the existing management team and the existing mandate, having examined it and recognised that actually much of the underperformance has come from style factors. So growth has been out of favour, and I think the managers have just found themselves in the wrong part of the market. But they think going forward, actually, the prospects for that look much better. So rather than changing the managers, they changed some of the structural elements of the trust. And I think here they're pandering somewhat. So I think the modern requirements. So they've introduced a 4% synthetic dividend, which I'm not a fan of at all, actually, for trusts that don't produce any natural income. But it seems to be popular, and so that's what they're doing here. They're continuing a buyback program, potentially putting a bit more emphasis on that. They're reducing fees, which is always a popular move. And I think most importantly of all, they're shifting the parameters of the tender offer. There was a 25% conditional tender offer in place, but that's now been replaced, and a 30% tender offer is going to take place in the third quarter of this year, followed by a 100% triennial tender offer as well. So effectively, there's a raft of measures here intended to provide much more discount management control.
So J.P.Morgan Indian is the largest of the trusts that are in the Indian sector, and I think has been regarded by many investors as the kind of core way to get exposure to the Indian market. But it's unfortunately been up against some other trusts, notably Ashoka India, which have performed much more strongly, have a completely different approach, much more kind of growth oriented, but have outperformed them significantly. Well, that's very interesting, yes. And so JP Morgan, if you like, have hung on to this one despite that relatively disappointing performance. It's still returned around 100% over 5 years. So, as we know, the Indian market has been very strong till recently. So, it's not like it's been a terrible absolute performer. Do you think this will be enough? Will there be a significant take-up of the tender in the third quarter? These things are always done after a period of negotiation with the largest shareholders. So, they presumably got a good idea of the kind of take-up they might get from a tender. And that's how they revised from 25% at a regular basis to 30% one-off this autumn. And then moving to 100% triennial tender. I always think 100% tenders are quite dangerous things, aren't they? Particularly over a short period like 3 years, because it's a bit of an accident when the point of tendering arrives, whether or not the market's done well or not, or your style has done well. But presumably this will now go through, but do you think this will be enough? If they lose 30%, there'll still be a significant size, won't they? So I don't suppose it's threatening to them in that way.
No, there's nothing existential about this. And I think probably for now it will go through, and it will succeed in giving the managers that breathing room actually to pursue their policy, and it gives them a bit more time. Clearly, if they continue to underperform, then perhaps in a year or 18 months, then the board may well revisit this. And of course, that increases the risk of a big take-up when they have these future exits. And I think it's a very risky strategy, actually, to put on a 100% cash exit tender, because we'll talk about another trust later on who's tried this and actually suffered quite a lot from it. So I'm not convinced that's a good policy. And with regard to this year's tender in the third quarter, of course, you're right. The board may have had indications from shareholders about their intentions, but everything might change by then. And when the third quarter rolls around, we don't know where global markets are going to be, what's going to happen in India, and also, crucially, where the discount on this trust will be. Because there's a logical point in this that if you can get out at let's say a 2% discount to NAV after costs, if the shares are trading in the market at an 8 discount, then logically you ought to do it. If they're trading on a 3 discount, you probably won't. So there's a lot of scope for variation here, and I think it's quite difficult to predict the outcome of that tender.
Yes, all you can say is that the discount has narrowed quite significantly from where it was. It's come in from around 20%, I think, was the low point in the autumn last year. So it's come in to around, I think it's around 7%, as you said. Well, that's going to be interesting to see how that one fares. I guess the board have taken the view that this is a case where you've got to improve the performance or else you will find yourself in even more trouble. So they've given the managers the chance to recover, if you like, from their relative underperformance. Well, let's mention that other trust I think you're referring to, which is Bellevue Healthcare. That certainly had an eventful period in terms of trying to satisfy shareholders' demands. Remind us perhaps of the background of this one and what is now being proposed by this trust.
It's a really interesting trust, this one, and it has a very idiosyncratic, concentrated portfolio of healthcare stocks. And the managers are really fascinating to listen to, very dedicated to what they're doing and interesting. But it hasn't done that well in the last couple of years. And so it's really suffered actually from its previous policy to have an uncapped annual redemption opportunity each November, this was. And actually, the trust lost a third of its assets at the last one in November 24. That, again, was partly due to market conditions that prevailed at the time not being very positive. So that wasn't working out very well for the trust. They were really shrinking quite rapidly, and clearly the cost base was fixed, and so the costs were rising for shareholders. So the board decided actually to water down that policy. So they decided to cap it at 10% and made it conditional on underperformance. So that was a shift there that actually didn't go down that well, apparently, with shareholders. So that's now been superseded. And the trust has said it's abandoning that policy and it's shifting towards a zero discount policy. And this is really intriguing because we have seen trusts actually manage a zero discount policy quite successfully over long periods. So trusts such as Capital Gearing Trust and Personal Assets. So effectively, they're using buybacks and issuance to interfere with the market mechanism to make sure that they're keeping that discount as close to zero as they can. And that's fine, actually, I think, for a trust which is a fairly low volatility, conservatively managed trust. I think it's quite different for a trust that's a sector specialist and is concentrated in that sector, which is quite volatile itself. So you're bound to have periods where you're out of favor, where your mandate isn't working that well. So I think this is quite a tricky process actually here for this board, and it's going to be interesting to see if they can indeed pursue this policy successfully. I'm not sure they're going to be able to do it.
Yes, it is an interesting one. I do recall now some of the history of this, and what the board said, I think, at the time when they made the original proposal, they had consulted the shareholders and talked to all the larger shareholders, and they're therefore somewhat taken aback when they discover that actually some of those shareholders, including a couple, I think, of the larger ones, actually changed their mind after they actually published the proposal and said they didn't like it after all. A bit of perhaps not particularly consistent behaviour there. So now they've gone for this much higher risk strategy, as you say. I mean, it seems to be working in the sense that the discount has come right in. It's come back to trading pretty close to par now. But yes, I've always thought that certainly, annual redemptions are a very risky thing indeed. And we saw the results of that. And that's not particularly satisfactory, partly because people do game it a little bit. If you think that some large shareholder wants to get out, everybody else will put in just because they want to get that little quick turnaround of performance, as you say. So you can actually find yourself with a much bigger sale of shares or demands for redemption than you would expect. Well, we'll have to see, as you say. I mean, it's unfortunate in a way that, as we know, with what Donald Trump has now proposed, there's also some risk around the sector as well, which you don't normally expect from Republican administrations. His threat to put tariffs on drug into the US. So it's all a very interesting situation, and we'll have to wait and see. But you think it'll be hard for them to sustain a zero discount policy without putting themselves at risk? Is that what you're effectively telling me here?
Yes, I just think that if you're imposing this kind of policy, then it has to be credible in the market. Because if you start to fail, then you've set yourself a very high bar here of keeping it at zero. And so if the discount widens out to 5% plus, question marks start to be raised quite rapidly and you lose credibility as a board, and that causes further unrest. So I think it's quite difficult, and it may involve quite a substantial amount of stock being bought back. I think that's the problem, that if you do start to get a persistent discount and you keep buying back stock, you end up shrinking the trust a lot anyway, which was what you were trying to avoid by instituting this policy. And this is a volatile sector. It's been one of the worst performing sectors of the year to date. And I just wonder whether this is a bit of a knee-jerk reaction. I appreciate that boards, of course, have to listen to their shareholders. They're working for their shareholders, and that's a very important principle. So we shouldn't criticize the board for giving the shareholders what they want, because that's what they have to do. But I do personally think maybe there's a little bit of unnecessary hysteria here about discounts, and maybe this is too strong a reaction, because actually the average one-year discount on this trust is 6.6%, which is, to me, perfectly acceptable. In fact, the widest it's been over the last 12 months is 12.4%, which, bearing in mind what's happened to the sector, I don't think is bad at all. So I don't know. I just feel this is a bit unnecessary and could end up shrinking the trust and working against the interests of shareholders. We'll have to see how it plays out.
Yes, and the market cap now is only 250 million. So if they have to buy back an awful lot of shares, that could shrink to a size that even for a specialist trust is not considered viable in today's markets. You are listening to our Moneymakers podcast. We are an independent research and publishing venture, and grateful to J.P.Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole. and many other regular features, including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's talk about another interesting development. This is one of the targets of the Saba 7 campaign, and that is Middlefield Canadian, ticker MCT, which has responded, if you like, to being targeted by Saba by adopting a strategy we haven't actually seen before by people who are in that position. So tell us what they're doing. The words active ETF are going to need to be explained, I think.
Yes, this is worth talking about because although Middlefield Canadian Income is a smallish trust, market cap of about 125 million, and quite specialist, so perhaps not really on the radar of many investors, this is very much worth talking about because of the principle and the fact that this could lead to a new exit route out of investment trusts. So what's happening here is that effectively Saba has a 29.3% stake, clearly wants to get out. And that's put the board under a lot of pressure here. So it's now proposing to effectively open-end the fund, convert it into a listed UCITS active ETF. So you might not know what that is. Effectively, it's a hybrid where it's a listed stock exchange security, an exchange-traded fund, but it is open-ended, so people can get in and out at more or less the NAV. And at the same time here, as part of this proposal, there's an uncapped cash exit. So that allows Saba to get out completely and other shareholders as well. So I talked to the manager, actually. I spoke to him this week about this because I wondered partly whether this was some existential threat really to the investment trust structure, if this was better in some way, or whether it was going to hinder how the trust was managed going forward. And it's quite interesting. There's a few elements to this, so bear with me. The first thing is that the costs will come down if these proposals go through. So the total expense ratio at the moment is about 1.3%, and the trust has said that's going to go down to about 1% if the proposals go through. So an active ETF is cheaper to run, which makes sense actually because you're using the umbrella of a larger ETF manager, and also you don't have the cost of your independent board. But that's a key thing. So your independent board disappears under this proposal. The other thing is that you don't have permanent capital anymore because it's open-ended, so the money can flow out. And fund managers always tell me that permanent capital is a wonderful feature, that they love having that. It makes the trust much easier to manage. So that benefit is removed. Although in this case, because the trust is investing in large cap stocks, it has plenty of liquidity, so that's not so much of an issue. Something else that's really interesting is that we always think, don't we, that one of the big benefits of the investment trust structure is the ability to take on gearing, which this trust has always used, whereas open-ended funds can't do that. Well, actually, Dean Arico, the manager, was explaining to me that that's not true. And actually, he can take on gearing in this new trust, just in a very different form using derivative swaps. So what he's saying is that actually, if the trust goes through this conversion, he can carry on managing the trust quite happily in very much the same way. So he's not going to feel very disadvantaged by that. Now, for shareholders, it might not be quite the same because I think active ETFs don't have the same visibility. They're not as easy for people to trade and to find out about. So I think the transparency actually may reduce. You're not going to have an independent board looking after you. So maybe it's not quite the same proposition. So the really interesting point here is if these proposals go through, which will be later in the year, it's just how much capital Middlefield hangs on to. So how many of those investors run for the exit door and how many stay with this new structure? I'm ambivalent about it. There's a part of me that's hoping it's not very successful, Jonathan, because I don't want lots of other investment trusts to convert because I believe in the current structure. But equally, I think actually this is a perfectly good trust and Canada's quite an interesting place to invest at the present time. So I don't want it to lose all of its capital. So it's going to be interesting to see how this one plays out.
Yes. Well, lots one could say about this, as you say. I mean, I have heard quite a lot of talk about active ETFs and indeed the extent to which they do pose a threat to the traditional investment trust structure. And I think you've highlighted the pros and cons very effectively there. I have to say, I've never looked at the share register of this particular trust, so I don't know how many of the shareholders are actually North American and more familiar with this kind of way of investing. They're less kind of plugged into the investment trust structure. And it is quite small, as you say. But if it is successful, if it actually ends up being perhaps even larger than it is today, then that would be seen as a weakness in the investment trust structure. Perhaps put another way, that this issue of how these large discounts have been allowed to develop has been an issue, and one that Saba, to their credit, you have to say, has at least highlighted. But at least it's interesting that Saba have found a way to get out of this one, presumably probably made some money out of this one as opposed to some of the others where they're being involved. So, yeah, one to watch, I think. It's also worth saying, is it not? I think I saw a note the other day from one of the brokers looking at the 7, how they're all performed. And nearly all of them have actually come up with some kind of solution now, or they're working towards a solution that will resolve the Saba issue. And at the moment, one can't say that the outcome has been necessarily terrible for the shareholders in those particular trusts. So this one, for example, the discount has come in from what, a 20% peak, I think. It's come into what, around about 5%, is it? Something like that. I don't know exactly what it is. And presumably heading towards zero as well when this transition comes round.
Yeah, that's right, Jonathan. So they're discounted into 6% here. And it's so interesting, isn't it? And I saw that same broker's note actually saying that, Saba's had actually quite a lot of success now with these trusts, and it is exiting quite reasonably on good terms. And actually, because of that, the note then contained the rather frightening phrase that Saba may now initiate a whole new range of stakes with new positions over the summer. Because actually, now that it's reverted to being a more traditional arbitrager rather than trying to take on the management itself, it's just agitating for change and then exits close to NAV. It's actually achieving quite a lot of success. So I suspect we might see a bit more of this happening. And just one other point, actually, about the active ETF element. I'm not sure it's going to be widely replicated yet. A lot of people might be watching this one, but it made more sense for Middlefield Canadian than it would for many other trusts, because actually in Canada, active ETFs are much more common. And actually, Middlefield has seen this happen to quite a few closed-end funds there. So maybe it's more appropriate for this particular trust than it would be for many others. We'll see.
Yeah, absolutely interesting for that reason. Let's move on. We can work our way perhaps relatively quickly through some of the other names. They're all interesting in their own way. One that I had an interest in is a thing called Regional REIT, which has a distinction, I think, of being the worst performing commercial property trust in the investment trust universe. And the reason it interests me because I got ambushed at a lunch the other day. I went to a lunch of people interested in investment. And at the end, the host asked for someone to give us their tip. It was this awful moment when people ask you to give you a tip, by which they mean, which trust is going to perform best over a very limited period of time, which is a mug's game. But if you've been asked at the lunch or the event, you have to give an answer. So I came up with Regional REIT only because it's effectively been bought up or taken over by another large property investor, and I thought it might bounce from a very, very wide discount. But anyway, tell me what's happened. Have I been bailed out of my enforced tip of this particular trust?
Well, it has gone up, Jonathan, so bravo. No, not by that much yet, but we'll see. It's still on a 46% discount, so it certainly has plenty of scope for a recovery. Yes, Regional REIT, it's the problem child of the sector for two reasons, really. First of all, because it concentrated purely on offices. And actually, of course, particularly after the pandemic, a lot of people moved away from working in offices and the demand went down. So it found itself in a very difficult space there in the UK property market. The second thing is that it didn't manage its finances well, and it had to go through an emergency rights issue to really rescue itself and raise some capital. And that was heavily dilutive. It was a heavily discounted rights issue. So that was really why the shares have been on their knees. So we just had an update actually last week from the trust, which was much more optimistic. It really had a much more optimistic tone to it, although the managers actually had probably been a bit over-optimistic for quite a long time. But crucially here, there was a specific indication that this trust's capital constraints have eased very considerably, and that it is deriving actually quite good revenue from its rentals now. So it's increased its quarterly dividend. That's the key. It's put it up from 2.2 pence a quarter to 2.5. And that's actually a very welcome increase. You're now getting a good yield on this. And it is really indicative, I think, of improving circumstances across the UK property market. Maybe this is the last trust to really pull its socks up here, but I think it's looking a bit better, Jonathan.
Yes, I hesitate to say that it hadn't warned us this question was coming up, and I don't actually own these shares, nor have I bought any, but I just thought there might be one of these things that might go from, 5p to 10p, and you can book 100% in theory gain, even though, of course, if you actually try to trade these things at that price, you wouldn't get that price anyway. Well, that's an interesting, perhaps micro development that we might keep an eye on. Let's talk next about HydrogenOne Capital Growth. This is ticker HGEN. This is one of these more recent early stage growth capital trusts that have come to the market and really taken a beating as interest rates rose. What's the story here?
That's a beautiful segue, Jonathan, because I reckon if I was asked that question about something that might shoot up in the near term, having been thoroughly squashed by the market, this could be my choice. I think it's really intriguing, this one, because the share price is about 22.5 pence. And the first quarter NAV that's just been announced is 89.3. So that's a huge discrepancy. It's about a 75% discount. I recently compiled some statistics actually for my newsletter, and this trust had the widest discount of all. And I don't really think that's justified. It hasn't done that badly if you look at the NAV. Again, obviously, it's a very specialist trust, this one, purely investing in hydrogen related assets. And that sector has developed less rapidly than the managers thought it would, in the UK especially. So it's not that anything's gone wrong in the hydrogen sector. And in fact, the trust has just released a 29-page hydrogen handbook, which is free to download from their website. So you can have a good read about exactly what the background is of the hydrogen market. And it explains all of the different colours of hydrogen: green hydrogen, brown hydrogen, grey hydrogen, etc. What is interesting here is that actually money is flowing into the sector. I think the development's just been less rapid than anticipated, and therefore this wide discount has come out. And the board has said that it's considering a wide range of options to deliver shareholder value. I mean, that's one of those very broad statements that could mean absolutely anything or nothing. But it does say that confidential discussions are underway with third parties. And the trust has been under pressure here, I think, to sell some assets just to demonstrate their value, that net asset value is real. So we could see some kind of development here that could be quite substantial and could see that discount narrow. It's speculative, no doubt about that, but I think a very interesting trust to watch.
Yeah, the shares are, I think, 22p or something around that range, obviously having listed at around 100. So that's not been great. But they are up year to date by around 3.5%, the shares, that is. So that's something. And up 8% in the last month or so since we last spoke. So who knows? Yeah. As you probably know, I did a podcast with Seraphim Space the other day. All these kind of trusts have been sort of lumped together, and they really took a hammering, all of them together. But there has been some signs of life. So if they've survived this long, you think that maybe they have a chance of surviving a little bit longer. The investors have not yet insisted on them winding up or whatever it might be. So while we're talking about very small trusts, we don't often do this, but let's have a look at Chelverton UK Dividend. This is one that used to figure quite a lot in people's radar, but I think has rather fallen off the radar recently. Tell us about this one.
Well, I think that's very apt. It has fallen off the radar of certainly some investors. This is a small trust. It's about 30 million of assets now. That's crucial. It's very small, actually. It's run by David Horner in Bath, and it has a very distinctive style. It's investing in high-yielding UK small caps. It does pay a high dividend, and that's been reliable over time. It has a good share price rating, so I think its existing ordinary shareholders like it. But it's really faced a big structural problem because it's always been geared using zero dividend preference shares. And those, of course, have a limited life, typically 5 years or so. So when they mature, the trust just rolls them over and carries on. However, when the latest tranche came to their rollover point, actually there was insufficient demand for the trust to roll them over. So it just had to pay off the zeros, which was £19 million. And it couldn't roll them over. So it had effectively to remove that gearing, and it hasn't been able to put any more gearing on at present. So that's why actually the trust has shrunk in gross size from over 50 million to now 32 million. And that does make it very small, and it makes it a bit expensive to run. So I did wonder actually whether the trust was going to be able to continue on that basis. And I like the idea of these niche trusts existing. They're serving a certain shareholder base that likes them, so why not? But in this case, what the trust has said is that because it doesn't have that gearing any longer, it's had to shrink the size of its portfolio. It cannot continue to pay quite the same dividends it was paying before. So in the common vernacular, it's rebasing its dividend, which means it's cutting it. So it's coming down from about 3.25 pence per quarter to 2.5 pence a quarter. So it's still 10 pence a year. It's still a 7% yield, but it's not the 9% plus that it was before. So this trust is relatively less attractive now. And it's a shame that it wasn't able to maintain its gearing, I think, because it was working quite well beforehand.
Yeah, it is interesting. It's also one of these trusts where I think you need to look at the share price chart rather than looking at just the snapshot numbers, because over 5 years it's done very well, but that's from the low point of the post-pandemic sell-off. And over the last 10 years or so, I mean, it's still well below the share price it was 10 years ago. And obviously you've had the high dividend to compensate, so the total return hasn't been as bad as that, but the share price has been falling. And I think the total return, according to my data set, over 10 years is 3.7%. So that's not great, but 11% over 5 years. So, as always with these statistics, you can pick and choose to put across whatever story you want, and that's something I think you need to be pretty wary of. So that's an interesting niche story. Let's talk about Chrysalis. This is an interesting development here. There seems to be some emerging signs that actually, even though there's hopes that this one is going to improve its performance, maybe this is approaching the end of its life. Would that be right? Is that how you would interpret the latest announcements coming out of this one?
No, I'm not sure I would actually. I mean, this was actually one of my ISA recommendations for the year, and I think it's in a really interesting position at the present time. So Chrysalis is a growth capital trust, and it's been under the cosh. This sector's been massively out of favour. It's been very difficult to extract value from it, and it's been on a mammoth discount. But it's been dealing with these issues, I think. It's introduced a very strong capital allocation policy with very significant buybacks. We often talk about buybacks, don't we, and whether they work or not. But I think in this case, it's a good example of how if the buyback is big enough, it can really have a significant impact on the asset value and the share price. The discount's still quite wide, but it's nowhere near as wide as it was. And in this case, actually, there's so much potential, I think, in this portfolio. There's a lot of news that could come out to really change the landscape quite radically. So where we are at the present time is that the latest quarterly NAV is 152.6 pence, which compares to a share price of just over £1. So a very big discount there. And the recent NAV performance hasn't been very exciting, but there's a lot of scope there. The big news here really is that the trust has a very concentrated portfolio. It's got big holdings in Starling Bank and in Klarna. So Klarna in particular, I think, had scheduled an IPO in the US for this spring. And of course, when President Trump upset the markets, that was then off the table, and that's been pushed back. But I think Klarna is still eyeing an IPO. And the Chrysalis managers, who I asked about this, they're very cagey about exactly how they valued Klarna in their portfolio and what value it might realize at an IPO. But they were able to say that, of course, they would be expecting an uplift. And so I think that's one potential uplift here. And the managers have talked about different scenarios for their major holdings. And actually, the numbers are astonishingly bullish. They're not just saying we could get a modest uplift here, but they're saying that over the next few years, they think if these businesses develop as they think they might, then the net asset value per share could rise to within a range of maybe 240 pence to 480 pence per share. So you're talking a very big uplift here. Clearly, that might never happen and it might not turn out that way. But it's such an interesting position. And at the present time, I think the capital allocation policy, where they're not making new investments, which I think is really what you were referring to, Jonathan, and that's a good point. They're not developing this trust for the future now. They're not making new investments. They're directing that money towards buybacks. But that increased the net asset value per share by 3.7% at this last count. So it's really having an impact, and it's quite significant. So I think this is another speculative position, but I do think it's really interesting and could be worth investigating a bit more.
Yes, to be honest, I'm not quite sure where I got that idea from. But in any case, I do notice the fact that they have been, as you say, very active in doing what they say and buying back shares, and that is having a positive impact. And the performance has been actually very, very sort of steadily improving over the last couple of years. But they've always been dependent, haven't they, on one, two, or three of their largest holdings actually coming to market, at least, and assuming that that would then lead to significant uplift, as you say, in the market valuation. So, yeah, well, good luck to them, is all I'm saying. I just wonder whether the overhang from all the troubles they had back in the day with their performance fee arrangements and all the rest of it, whether there's a kind of feeling that, yeah, we'll see this through to the realization, and hopefully that'll be very good, as you say. But beyond that, will they actually want to refresh it and keep going? I've certainly talked to some people who I think point me in the direction of a different feeling there. But in the meantime, all well and good. So that's continuing to make bullish noises, and that's excellent. Finally, then, Andrew, another interesting, call it special situation maybe. Let's look again at the battery storage trusts. We always talk to you about those because I know you've been fairly positive on those recently, and they have done well since having done very badly before that. And there's an interesting development at Harmony Energy Income Trust, which is one of the three battery storage trusts that are significant size. Tell us what's happening there and why that might be significant for this mini sector as a whole.
This is just a really intriguing story, and I'm following it with bated breath, actually. So, Harmony Energy received a takeover bid from Foresight, which seemed like a pretty decent bid, actually, straight off the bat. That was then trumped by Drax, and the board recommended that. And then Foresight came back again with another bid, pretty much at net asset value at 92.4 pence per share, which looked like a knockout bid, very attractive. The board recommended that one. But actually, it seems that this isn't over at all. And the share price is just over 96 pence. So it's at a premium to that last bid. And it seems that actually these two parties haven't finished. So the bid has not been declared final. And the trust has now said that this week it's going to conduct an auction procedure between these two bidders. It's like a boxing bout. It's going to be a 5-round bout where they have the opportunity to raise their bids. And they might not. So 92.4 might be the top. But the fact that this is taking place rather indicates that it won't be. And we'll have to see, actually, whether the bid comes out to be significantly higher or not. The market's betting on it being maybe 96. But it's quite fascinating. I've never seen this occur before. And it does demonstrate, actually, that there is competing demand here for these assets. And I just find that so difficult to square, Jonathan, with the rating on these other two battery trusts in the market. They are different, so it's not quite the same. You're not comparing apples with apples. But nevertheless, a 43% discount on Gresham House Energy Storage and a 37% discount on Gore Street Energy Storage just looks anomalous to me. Those have come in quite a lot, and these trusts have really been pretty good performers in this year to date, amongst the best actually across the sector. But nevertheless, I think there could be a bit more to come.
Yeah, I've been following that with interest. Yeah, definitely. I'm looking at the numbers now. So year to date, well, Harmony Energy Income is up 48%. Gresham House is up 41% and Gore Street Energy up 30%. But as you say, the discounts are still very wide in those last two cases. So, yeah, as you say, there's a bit of a mismatch here and the asset mix may be different. But yeah, I would certainly see that as a positive sign for the sector as a whole, which, to be fair, they have been beaten up very badly, haven't they? Perhaps you might just remind us why they got beaten up so much and what it might take for the sentiment generally to reverse. What are these bidders seeing that the market is not seeing, would you think?
Well, I think rather like the hydrogen sector, this is a sector where the hopes were very high. It seemed like such a splendid technology, a very obvious use for it, because if you're using renewable energy to put power into the grid, that fluctuates a lot. You can't control it so readily, so you need the battery storage to smooth it all out. That makes complete sense. Clearly, we need batteries as part of the system. So this really seemed like a terrific new industry. But actually, its development has been quite difficult, partly because power prices have weakened, but more so because actually in the UK especially, or Great Britain, I should say, the grid actually has not been very receptive to the use of battery storage, and it's froze them out for a little while, actually. So actually, it's meant that these trusts have really had to juggle with their different revenue streams, and they've had to figure out how they can make good, reliable revenue whether that's from trading the power by buying it when it's cheap and selling it when it's expensive, or whether they have fixed contracts with the grid to supply and smooth out that demand. So actually, I think they've had a quite difficult growth period here, but fundamentally it's a good idea and they're going to succeed, I believe, in the long term. But clearly it's been a very bumpy ride. And once these things start to go to wide discounts, then they become embedded, don't they? I think there's some anchoring that goes on, and it's quite difficult for these trusts to continue. It hadn't helped, of course, that 2 of the 3 trusts suspended their dividends because their revenues were so squashed, actually, by the grid for a while. Gore Street carried on paying its dividend, but that's been a big problem.
Yes, I was going to make that point. It's one of the oddities is that you could look for explanations, but one reason might be, well, they did suspend their dividends and therefore the kind of natural clientele for a lot of this were people looking for income and therefore they would disappear, if you like, off the register. But Gore Street Energy didn't suspend its dividend and still offering a very high yield. And yet it's got almost as big a discount as Gresham House Energy Storage, which did suspend its dividend. So go figure, I guess, is what we say there. So that brings us to the end, I think, Andrew. We haven't talked this week about the volatility in the market. We're all getting used to that now. It's on, off. And we've seen some very dramatic moves up and down in the sector. A lot of polarity in that. But we can leave talking about the market as a whole for another day, I think. A lot of interesting detail around some of these smaller vehicles in particular, which I'm really grateful to you for bringing up. And we can talk about them, which we perhaps don't do as much as we should do. Certainly, it seems to be a more positive backdrop for some of these trusts anyway. So that was Andrew McHattie, the editor of the Investment Trust newsletter, talking to me earlier this week.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.